Welcome to Opal TV. Today I'm in London together with Mark Walker from Tollymore Investment Partners. Tollymore runs a high-conviction global equity concentrated strategy. For the last 4 years, Tollymore has achieved a 20% annualized return. But before we look into this strategy, Mark, tell us more about your background and why you launched Tollymore.
I have 15 years experience in financial and business analysis, and that was really gained in the fields of corporate finance, in sell-side equity research, and then in long-term global equity investment management. Tollymore was really launched as an effort to create value for long-term minded individuals, family offices, endowments and foundations. It's really an attempt to create value for those investors with very long-term and potentially perpetual investment problems that they're trying to solve. So that's the kind of professional impetus behind the endeavor. And then from a personal perspective, I think that if you're going to try and attempt mastery at something, it makes sense to really do that in the context of 100% autonomy, and also to do it with a set of stakeholders who will support that objective. And that's what we've really built here with Tollymore.
So Mark, let's drill down a bit deeper. What opportunity set are you focusing on in the crowded field of active investment managers? Or put it the other way, what problems are you trying to solve?
The opportunity is not a especially exotic or unique investment strategy. It's not demonstrably superior analytical ability or off the charts IQ. It's really a recognition that behavioural edge is the most obvious source of competitive advantage in this industry. But pursuing a behavioural edge requires doing things that are unpalatable or just not possible in the vast majority of institutional money management environments. It requires being epistemically humble. It requires spending lots of time alone, carving out space and time to think independently. My vantage point as a sell-side analyst actually gave me quite a good overview of the institutional money management industry and how the actors in that industry are incentivized. And it gave me a good overview of actually the institutional constraints that they face to making good decisions. So they are faced with career risk, which encourages them to take a short-term view or to guess share price movements. They are focused on having very precise estimates of the future, which is typically a low ROI exercise. Alignment of interests is typically an afterthought, with very few fund managers directly invested in the funds that they manage, and fee structures which have not given consideration to the proportion of alpha that an investor versus a manager should enjoy. I think that I saw a lot of what I call pitch book mentality, so that investment strategies are a product of what might look good in an investor presentation without necessarily a deep level of thought or introspection about what is efficacious, what might work, what might be consistent with generating outperformance. And then in terms of the roles and responsibilities in larger money managers, I think that there is a division of responsibilities between analysis and portfolio management, which I think is usually antithetical to good investment decision making, because it is the analysts that typically gather the conviction about the long-term prospects of businesses, but portfolio managers, who are typically faced with making decisions under duress or under share price volatility that perhaps are more encouraged to use the share price as a signal of value, and they're therefore less able to generate value under conditions of uncertainty. Analysts are also typically specialists in their field because they are trying to convey institutional suitability via analytical superiority. And so they're not focused as much on exercising sound investment judgment. So for all of those reasons, I've kind of seen this professional opportunity to create a different model, a partnership model, a model in which the manager considers their investment partnership relationships as a genuine source of edge in being able to execute a long-term investment strategy. And once you see your clients as genuine partners, your behavior changes. Your clients are not a mechanism for you to get rich, but they're an important ingredient to generating an acceptable annual investment result.
Mark, let's look into your investment philosophy. Tell us more about that.
We make decisions in the interests of long-term investment results. So in the short term, I think that there can be little correlation often between price and value, between business success and stock success. But over the long term, that correlation is high. That disparity is the key to making money as we see it, but it's a disparity that can persist for long periods of time. So therefore it pays to have a patient temperament accompanied by a patient capital. I think that as a long-term investor, we have two principal advantages. One is the capacity to exercise a time arbitrage in a market where average holding periods are 8 months. It's the ability to be a buyer of securities from a seller who is selling for non-fundamental reasons, because he is facing redemptions, because he has pressure to not deviate too far from a benchmark, or because he is facing redemptions from short-term capital. Secondly, it allows us to assemble a portfolio of companies capable of increasing their own intrinsic values over the long run, and to let them do, hopefully, most of the work for us in generating acceptable annual investment results. So I guess that's the first element, is the capacity to exploit a time arbitrage or a long-term investment horizon. Secondly, we have a value-oriented investment approach. What that means to us is that we're trying to maximize the intrinsic value of a group of companies. As I've said, the principal mechanism to doing that is invest in those companies capable of compounding their own earnings value over the long term. But we're also trying to do that by buying those assets at strong discounts to current intrinsic value or current owner earnings. Thirdly, the way that we view catalysts is that time is the catalyst. We are not short-term investors, therefore we do not need a catalyst to induce a re-rating of an asset to earn our investment results. And in fact, we think that where catalysts are readily identifiable, there's unlikely to be this very large gap between price and value, and it's those large gaps that we're seeking to profit from. The implementation of this philosophy is through a concentrated portfolio of holdings. We typically hold between 10 and 15 securities. We're fully invested. We disagree with conventional wisdom that diversification lowers risk. Rather, excessive diversification can inhibit the due diligence required to know how to act when the quoted price changes. And it's that really that leads to permanent impairment of value. And finally is how we think about downside protection. Volatility can actually afford us the opportunity to acquire the same assets for lower values, which lowers our risk of permanent capital loss, even if the future unfolds in a less favourable way than we anticipate.
How do you now go about finding investment ideas?
So what you might find in most institutional investment programs is an idea generation process predicated on a quantitative or repeatable screen. Now, we typically don't find ideas using screens. We have a number of issues with screens and their efficacy for generating long-term investment results. One is that a screen may well have worked in the past, but given the significant business model transitions that have occurred over the decades, there's no real guarantee that by continuing to fish in that pond that you will generate acceptable results in the future. Secondly, what we've seen is that screens are again part of this pitch book mentality to which I referred earlier. They are a mechanism to convey repeatability of a process and therefore institutional suitability without due care and regard for the efficacy of that part of the investment program. And finally, and probably most importantly, I think that screens for us would have really missed a very rich source of investment opportunities, which are those companies whose reported financials really poorly reflect the economic reality of their business prospects. That could be due to accounting convention, it could be due to very high reinvestment rates in the business, or business model transitions. So we prefer a process in which ideas are really generated serendipitously through engagement with company filings, engagement with investment reports, reading journals, investor newsletters, 10Ks and Qs of the companies under study, their peers, their suppliers, through meetings and conversations with management teams, through reading the letters of our investor peers and having conversations with like-minded and intellectually generous investment peers. And we find that process is perfectly adequate if you are competent and you are passionate. And the goal here is really to exercise sound judgment when you encounter an investment idea, and actually to say no as quickly as possible and as early as possible in encountering that idea.
So we talked about screening, or that in fact you don't screen. But tell us more about your research process when you're looking at companies and investment opportunities.
The research process is bottom up, one company at a time. We're trying to dedicate blocks of uninterrupted focus to interrogating our perception of a business and a management team's quality. And the vectors along which we determine quality include the simplicity of the business, the appropriateness of the company's capital structure, the track record of the business and its management team, the sources of competitive advantage for the business, the growth runway at acceptable returns on investment, and the stewardship of the business. Valuation work tends to focus on understanding what a through-cycle, long-term owner earnings of the business might look like. Those owner earnings are really the cash that management could put into the pockets of owners of the business if they only invested what they needed to maintain their competitive positioning and their unit output. We then look at those owner earnings and we think about what should management do with them and what is management likely to do with them. What are the reinvestment rates of the business, and what are the sustainable incremental returns on capital? And that gives us an understanding of what a likely range of IRRs that equity investors could earn at current prices.
So in investing, risk is obviously part of the equation. What is your framework when you assess risk?
So in seeking to safeguard against the permanent impairment of the portfolio's capital, we look at business risk, balance sheet risk, and valuation risk as it relates to the holding companies. So business risk is the company, in the absence of lasting unfair business advantages, might suffer from a deterioration or an erosion of its enterprise value. through low barriers to entry, for example. Balance sheet risk thinks about then how much of a company's enterprise value growth or preservation is likely to accrue to equity owners. And it may well be the case that a company has these lasting unfair advantages that protect the enterprise value and potentially grow the enterprise value over time, but that growth in enterprise value accrues to debt owners more than equity owners because of an inappropriately capitalized business model. And then thirdly, valuation risk is the risk that the business may be very high quality business along the vectors that we've discussed. It may have a balance sheet that is perfectly conservative or appropriate for the business model, but that we as equity owners pay a purchase multiple that is too high to enable us to enjoy an adequate IRR as equity owners. So that's from the holding company perspective, how we think about risk. And then from a portfolio management perspective, as I mentioned, we don't use diversification as a tool to dampen volatility. This is not, Tollymore makes no effort to smooth investment returns and tend investment results to average. We avoid leverage at the portfolio level and the holding company level. This is a long-only strategy. We're focused on quality businesses with quality management. And finally, at all costs, we are avoiding complex situations.
So Mark, summing up, what would you say is Tollymore's edge as an investment manager?
The edge is not simply being a long-term investor, but it's being able to execute a long-term investment program. That ability is afforded to us by an investing ecosystem that recognizes behavioural edge is really the only real competitive advantage in this business. It's an ecosystem that we think allows us to do two things better than our peers. One is to admit mistakes and acknowledge ignorance and to learn from those mistakes. And secondly, it is an ability to exercise conviction and to lower our cost basis of the holdings that we have, if that is very clearly in the interests of the results of our clients. So I guess what are the ingredients of this ecosystem? Well, one is this long-term investment horizon, the ability to participate in a market in which many sellers are selling for non-fundamental reasons because they think news flow will be negative for a few quarters, because they are benchmarked against short-term measures, or because they have short-term capital and are facing redemptions. Secondly, to benefit from the right environment, have a physical working environment that allows us to carve out space and time to think independently, that distances ourself from noise. The right temperament, or a temperament that is consistent with that environment, an acknowledgement of the power and utility of self-awareness, an ability to be patient, to keep things simple, to adhere to a disciplined investment process. And then finally, the right investor base. So investment partners who are able to naturally think unconventionally and act countercyclically is an enormous competitive advantage in generating the right results for all of Tollymore stakeholders.